So it's my privilege to introduce Dipender Saluja, managing partner of Capricorn Investment Groups. He is a champion of tough tech investing in companies like Redwood Materials, Form Energy, Planet Labs, QuantumScape, Joby, and some of our old favorites, Tesla and SpaceX. He has been a force in how to invest into tough tech and long-term capital-intensive businesses that matter. And he has really laid the groundwork for a thriving tough tech ecosystem. I admire his fortitude and his ability to continuously learn as market shifts. Welcome, Dipender.
Thank you, Katie, for that very kind introduction. It's a pleasure to be here, and thank you for organizing this amazing event.
Okay, so we have about 40 minutes to dig into some juicy areas and topics that I know both our founders care about, but also fellow investors. And I think you have proven in a career of investing kind of how to bet on really big, important companies, whether it's in climate change or, several areas in that zone. When you step back and decide to invest, what are the things you have to believe in order to make a really big bet?
Well, I think you touched on this in your opening comments. It's, for us, it's really the intersection of really big problems that we see as big opportunities. It sounds cliche, but think of the context that we were in 20 years ago. We were coming out of one of the biggest booms in Silicon Valley, and in a sort of slow motion way, this huge wealth creation opportunity in Silicon Valley had come up, but it had shifted from several decades of what we now call deep tech in the 70s, 80s, 90s, to all the fruits of that deep tech, which had provided us these platforms and enabled folks to rapidly do a bunch of modifications of business models, create the entire domain of consumer internet, web browsing applications, mobile applications, etc. And somewhere there, the focus shifted from tackling tough problems to essentially tackling new opportunities in business model. Nothing wrong with that. Like I said, a great wealth creation opportunity. But after about a decade of that, it became pretty apparent that we would not be able to solve some of the big challenges and opportunities that were ahead of us, whether you mentioned energy or healthcare or transportation or food and agriculture, without creating those platforms that were needed for the next generation of all of those industries. And so it's really that intersection of some of these big problems that can be really big opportunities. We have several examples now, some of which you mentioned today around us that have successfully done that. And of course, at the heart of it all is amazing entrepreneurs that have the vision and the fortitude and the abilities to create those companies. So we look for those entrepreneurs, and the table stakes is, big idea, big problem, with a technology differentiation in our case.
Wonderful. And when you think about working with those entrepreneurs, which I know is the fun of it often for you, where do you like to lean in? How do you like to be effective? And just describe to us kind of what's interesting for you. And is it the earliest stages, or just give us a little color on your life as an investor, and what do you do to help?
So, there are many areas that need this deep tech innovation. And again, you alluded to that at the beginning. We started when Jan, my partner, and I got together to do this about a decade and a half ago. We looked at some of these areas primarily with climate and energy in mind. And the first area that we decided to do something in was electrification of transportation. And that turned out to be sort of the start of our focus on electrification of everything. Transportation, cars seemed like an easy, quick, low-hanging fruit type of area because as engineers and physicists and material scientists, it just appealed to us that cars should be electric. And this became pretty obvious 20 years ago. In hindsight, it's obvious to everybody now. But, at that time, folks like J.B. Straubel and the other co-founders of Tesla were really working on these battery curves and power electronics curves, the kinds of innovation that had happened in the adjacent areas. And it started becoming obvious that that was the future. Well, the same started becoming obvious in things like solar energy, which, again, if you remember 20 years ago, were 10, 20, 30 times more expensive than where it is today. But we were all used to that in the semiconductor journeys that had happened here in Silicon Valley and the other electronics industries. So, we like to pick the areas that have that convergence starting. Many of these companies also depend heavily on several disciplines, right? So it's not just one innovation or the invention of one material. It's often a convergence. And so if you think about some of the industries that you and us are looking at, many of these things would not have been possible 10 years before they started, or sometimes even 5 years before they started. It's really when that perfect storm can come about and that convergence can happen. And so we look for companies and areas in which that convergence is there and the ability to scale is there. Our biggest failures, if you may, have been not in areas that were a dumb idea or completely crazy or did not deserve to be done. It was either a question of timing or team. And timing is something that is, that you just have to watch. A dumb idea 20 years ago can suddenly become a really good thing to do. Many things evolve. Something that wasn't successful and even a sector that wasn't successful can eventually come into being. And so, tracking fundamental technology development, tracking that differentiation is something really important for us to keep doing. And then when that combined with a good team appears, that's when we like to invest, and that's when we think the opportunity to really make a difference and build something big appears.
That's wonderful. So I think just pulling on that string a little bit, yes, you need a team, yes, you need a big market, but there's also this concept of being patient and knowing that it takes a while for these things to develop because there is real technology. And there's also strategic money out there. So there's the need for patient capital and the need for strategic thinking and strategic capital. This is a complicated question, but how do you weigh that when you're thinking about, you have this wonderful team, how much time do they have to develop this? How do you give that to them? How do you make sure that they can get fully to market? Just riff on how you think about things like that.
So, Katie, I think the idea of patient capital has sort of, come back more because of that period of time that I talked about, where we kind of, as a community of investors, got spoiled a bit. Developing good technology and iconic companies and sort of companies that matter has always been a patient exercise. It's rare, that sort of fantasy of two kids in a garage suddenly wake up one day and voila, there's an amazing company. Those are non-existent or few and far between. It's usually, like you described it, a patient grinding process to build these companies. So I think capital to build good companies always needs to be patient. And teams and investors and boards, need to be patient because you're building something, hopefully, that is going to last a while. And this idea of being able to do it without that patience or without that patient capital is something that I think we had maybe the benefit of a decade when we were able to build consumer internet businesses really quickly, or figure out how to sell pet food on the internet, or whatever your favorite example is of that. So to us, that patience of capital and patience of purpose and intentionality is just fundamental to this. So I don't think that is something that is that can be avoided or needs to be unique. A lot of people talk about capital intensity, and you didn't ask that, but I think it's related. Mm-hmm. As you know, a lot of people shy away from this space because they're worried about the capital intensity. To me, it comes down to, again, when is that capital intensity required? In the kinds of companies that we're talking about today, that capital intensity is early, and it starts early, and the visibility into that capital intensity is early, which is why it tends to scare people. But to me, it's not that different in other companies that are quote unquote less capital intensive, because if you think about a company like Uber or most companies again, I'll take the consumer internet example, where customer acquisition is what determines who wins. In those situations, for a long time, you're wrapping either car rides or whatever you're selling in $10, $20, $100 bills and asking your customers to acquire them from you. And that can take billions of dollars, sometimes several $billion a year to do that. And that is capital intensity at another scale. But it's capital intensity with what feels like less unknown, because it's not like you're spending $200 million before you get a chip back, which is what happens in most semiconductor companies that are trying to build a new company. There, it's a little more real time, and you can see whether your customer acquisition costs are better than the other, and whether you're acquiring more customers, et cetera. And if you really step back and look at some of those platforms, you have situations literally where famous companies that we all know about and use and love day to day, are spending sometimes several $100s to acquire a customer who maybe for over the lifetime of their customer relationship, only worth $10 or $20, not to be crass about it and talk about just dollars and cents. But since we talk about capital intensity and patience, I think, when you step back and look at the capital that you spend building a deep tech company, which is going to build a new product, which is going to employ several people to build it, create manufacturing jobs, et cetera. Being able to have the capital to build that just feels so much more productive and longer lasting. And frankly, to me personally, an easier investment to underwrite than to figure out more of a play that will depend on fashion and in quotes, or ability to grab customers over your competitor without any real differentiation or any value proposition that is different other than how much money you have to spend acquiring that customer.
Oh, there's so much to pull on in those comments, and amazing. I think I'm going to go to LPs and then I'll come back to kind of capital partners in a minute. So you've just finished raising another set of funds, and I am quite sure that people were excited to follow you and to follow your lead. But when you think about limited partners today and the shifts that have happened either around ESG or impact investing, which used to kind of be a dirty word, like it basically meant you're going to lose money. And today I think that those norms are shifting, and I think partly because of your last comments that people are seeing you can make really good returns in these deep tech or tough tech areas. Can you talk a little bit about how you're seeing the limited partners shift and how you think about that? And are those good trends? And what do you think is going to continue to happen?
So again, when Jan and I started doing this about a decade and a half ago, one of the things we wanted to do, besides invest in great companies and have an impact on some specific areas, was to also think about how do you mainstream this whole space. And I think that's what you're alluding to here, as opposed to this being the work of a handful of people, or this being, something that is in cocktail conversation sort of land, or just a few high net worth individuals. It was really about how do you mainstream it? How do you take it out of just the ESG focus of a lot of people? And that ESG focus being, let's say you have an endowment and you have a 5% pool to give away or, do grants or philanthropy, and say, you know what, I'll use that 5% pool to invest in some of this other stuff as well. Very early on, those were the pools of capital that were primarily available for things like climate investing and impact. And our thought was, listen, this opportunity here is not just about having small bits of really good impact or doing the right thing, but really to create the next wave of companies, the next forms of energy, the next forms of transportation, the next forms of healthcare, all of which the world was hungry for and needed. And in that process, it was going to create several companies that were going to be worth billions, tens of billions, hundreds of billions. And I haven't looked at the stock price today, but $1 trillion company, right? One of our first and favorite ones, Tesla. And so the only way that was going to happen was if we mainstream this capital. And so in your question about LPs, we, this really has been a fun journey to watch as this has moved from, a handful of people sitting around tables discussing, what the term impact investing would mean, or even coming up with that term to begin with, and how people could syndicate between small groups of people, to mainstreaming it, where you have the pools of capital that you're used to in traditional venture capital and private equity, whether it's pension funds or university endowments or fund of funds or investment banks around the world or corporates, in addition, to the well-meaning family offices and foundations. So that has been one of the fun and fulfilling parts of our journey, has been going from, like I said, a small group of really well-meaning people who were pioneers and had the vision and desire initially, to where now there are hundreds of well-known LPs who are LPs in traditional venture funds, traditional again in quotes, that are starting to lean in and invest in funds like ours, which are going after impact and deep tech and climate.
That's wonderful. So let's cut back to the entrepreneurial journey right now. A lot of people ask me, is climate or clean tech overhyped, and are so many new investors pouring into that? What's going to happen? Are prices too high on these companies? You get kind of this, in the hype cycle, you get that negative side of it. Yet when we look around, and I think we share the same view, there are so many incredible companies in my portfolio, but in yours and in many other people's, that are growing companies that really matter and that could be very large foundational technology companies. And they don't have all the capital they need, right? There are different gaps in the capital stack. So when you think about what's happening today that's good, and you think what more needs to happen, can you just kind of riff on that in order to enable these great entrepreneurs?
Absolutely. We are going through that cycle that you described. By the way, that is very natural, right? As a sector becomes successful, it attracts more investors, it attracts more capital, it attracts better entrepreneurs. And that creates a really nice virtuous cycle, because as you get more entrepreneurs, more capital, you increase the chances of success, you increase the success stories, you also increase the failures because the volume is just there. And that is something that it's, we've all been kind of waiting for to some degree. Will that cycle get overhyped? Absolutely. Will valuations go up? Absolutely. Will there be more deals that get funded that don't deserve to get funded? Absolutely. On and on. I won't be able to tell you anything different about this cycle or a future cycle than we haven't already seen in past cycles in any aspect of venture or tech. What I will say, though, is some waste, some sloppiness feels worth it in this space, not because we aim for sloppiness or waste, but it's just a part of the reality of the business, which is the dynamic that I told you, that people get attracted. We want people to be attracted to this space. We want capital to come into this space. We want entrepreneurs to have the ability to have more than one term sheet that took them 2 years to cobble together, right? It sounds like an exaggeration, but there were several instances I can remember where it took companies that are darlings of the space right now over a year or two to get their first 10, 15, $20 million together. And it was an incredibly lonely place. I think the only thing in hindsight you can take comfort in was there was no competition for funds like you and me. But I would not trade that back under any circumstances. I think the space is much more vibrant. There's a lot more buzz. There's a lot more excitement. There are a lot of alternatives. People have the ability to take multiple shots on goal. People are taking more risk, et cetera, et cetera. And all of that to me is goodness, especially in the space that requires us to be doing a lot more than we are doing today. And there's just so many areas that can benefit from this. Like I said, whether it's energy or food, agriculture, water, healthcare, etc. So that dynamic absolutely exists, which means we have to be more careful. I think good investors are always careful, even if the only competition in the room is themselves, or the only offer on the table is themselves. A good idea is a good idea. A bad idea is a bad idea, no matter how many other people like it or want to invest in it. And I think what it will do is create an environment where there will be plenty to go around and plenty of good ideas to invest, because it'll make that one fundamental change happen, which really fuels this space. And it's the number of entrepreneurs and the quality of entrepreneurs who come up with that idea. Most people are fixated on the capital, but you and I know capital can become a commodity. Yes, the teams that come with the capital are differentiated, and you can have a better set of investors and a better board around the table, which is all very, very important. And maybe we can talk a little bit about that. But capital at the end of the day, especially in the last 2 years, 3 years, and right now, you can see there's no shortage of capital around the world. There's still trillions of dollars, trying to get out of negative yield territory for many constituents. And so there's no shortage of capital. It's really the quality of entrepreneurs, the quality of the ideas that determine the success of the space, supported by the capital. What the capital does, it gives those entrepreneurs the confidence to step in and to come out and say, I see enough capital that's going to get me from here to where I need to get to. So I don't have to constantly worry about how am I going to fund this great idea I have. So let me go all in, take the risk, build a team ahead of my ability to demonstrate the concrete success, so that I can have that runway to build that. And I know many entrepreneurs, I'm sure you do too, who were completely capable of and had great ideas 10 years ago, but simply did not build companies because they said it's impossible to get it funded. There are not enough investors, there are not enough LPs, there are not enough mandates. And so they went off and did something, which you and I would consider silly, but was fundable, and did it. And now, much to our delight, we're seeing several of them who've, done that frivolous startup that made them money, are coming back and saying, now I want to solve the problem I really dreamt of solving, or I feel is important, or is my next, or is going to be the next big thing.
Those are all wonderful examples of what's happening right now. Okay, so let's talk about government. We just heard from Secretary Raimondo, who's doing a whole bunch with the Commerce Department, but also collaborating across government. There are a lot of tailwinds for clean tech and tough tech companies who are building things, whether it's going to be procurement dollars or mandates. Tell me how you think about those kind of government forces and how that's going to help our entrepreneurs, and maybe if there are any watch-outs of what you don't want to do when you're building these companies.
So I think that one is complicated, Katie, and I think you and I have discussed this when we've been around the table on a couple of our companies. It's obviously all else being equal, it's great to have these tailwinds. It's always nice when governments are supporting this activity, because government policy has a big impact at the local level, at the state level, at the country level, and now hopefully, even as we go into COP, even at the global level. But as we've all seen, that is an extremely slow-moving machine, and the politics of the day, and this is around the world, is fickle. It's hard to guarantee that there will be continuity in that policy and thought. And will this get whipsawed around as you see governments change and what is popular move around. So all that to say that having the tailwinds is obviously a great thing because it puts it front and center. It's great to have it in the national conversation all the time. So all else being equal, I think that's great. But for many startups that we're talking about here, right? They can't hang their hat on that. So I don't think you really fundamentally change the criteria or how you do things. I remember, again, 15, 20 years ago, there were several sectors in which that was almost a singular focus. People would say, I'm going to help you build this company because I know how to deal with Washington, or I'm going to help you build this company because I can influence policy. That was really short-lived. Yes, there are insights to be gained from that. Yes, it is amazing. There are some amazing opportunities to say, I see energy policy heading a certain way, or the way this is going to evolve, and so I will adapt my idea around it. But fundamentally, these companies have to be built on the same solid principles, government tailwinds or not. Some areas in which I think it can help us more than others is getting a little bit more comfort around scaling, where to manufacture. That's obviously been a huge debate. We have so many examples of companies that get started, have their birth, and do all their IP development and early stage work in places like Silicon Valley and Boston. And then when it comes time to really scale, they have to look for a completely new geography, often around the world, to go build their product that they have designed and created, or get it built. And so things like that, we can maybe start planning for and watching and seeing whether more of that happens regionally, whether more of that happens here in the US, versus the same model as before. So I think some of that will matter, especially for many of our companies that are ultimately going to manufacture things at scale and manufacture lots of that, like of any whether it was solar in the past, or electric cars, or batteries, or electric airplanes of the future, or power electronics, et cetera, et cetera. I think there is a lot of excitement around some of the loan programs, which are very important from a US context. Again, related to what I just said, there are geographies and countries that have always had those types of incentives. And there's always been the struggle of, do you give incentives to attract companies, or do you let companies just do it on their own from the private sector, et cetera? And we're seeing movement in that space. I think, the Tesla example is always a good one to hold up, that if they hadn't got their $500 million loan from the DOE back in the day, who knows whether they would have been able to cross that chasm and really become the powerhouse that they are today. And that ended up being good for everybody, right? It ended up being good for the car industry in general, right? For the first time, and after many decades, you had the emergence of a company that actually got some excitement in the space. It obviously started a revolution. Now everybody is trying to do it. And I wouldn't be surprised that, when more history books are written, there's already been several books written about this, but when more books are written, that they trace it back and say that was a pivotal moment. And that was very important. It wasn't the only thing that enabled them to succeed, but it was a necessary thing for them. And I can see that happening for several companies that are in that process today. So, some of these programs that are being talked about, I think, are incredibly important, and they will inject the needed capital and the needed push to get these companies to scale. And that's really important because if we can help some of these companies scale, that will accelerate what needs to be done. And when you hear about this problem, I'm sure you hear it all the time. Time is not on our side. And so accelerating any good ideas without sort of messing up the marketplace is very important and will help all the stakeholders.
What a wonderful set of comments. Okay, maybe one last juicy topic. So you work with so many founders and have been a trusted guide in growing companies. We're in a moment now where there is more capital. There's a lot of different types of capital and different ways to exit. There have been SPACs for many, many years, but it hasn't been a tool that we've used. You have late-stage corporate investors coming in. You have many new late-stage funds being formed, whether it's for straight mezzanine rounds or all kinds of different forms of debt capital. If you're guiding entrepreneurs, how do you help them today in this environment when they come to you and say, you know what, I'm going to SPAC, or should I take $500 million right now when you thought that wouldn't be available to them for years? Like, what is your advice to them? And I know everyone is different, but in general, how are you guiding people?
So it's a very important point, Katie, and discussions that, as you rightly pointed out, happening with many companies. And the guiding principle I like to use is, again, that scale and time piece that I just talked about earlier. If the capital can enable you to accelerate and build faster, do something in parallel that you would have done in serial, simply because you didn't have the capital, you should raise the capital. You shouldn't raise the capital just because you'll sleep better at night that you have all this capital sitting in your bank account. You shouldn't raise capital simply to give people liquidity 5 years before it would have been natural to give people liquidity, when the company hasn't even delivered the product or built what they set out to build, right? Those would be not good reasons, good intentions. In fact, they would be bad reasons and bad intentions. So I think the guiding principle is, if you can use the capital for accelerating, if you can use the capital to scale, if you were thinking of building a smaller factory because that's all the capital you could get, and then proving to the world that it would do even better, you can take more risk right now because you have that capital available. And by the way, that capital is available from multiple sources. I think the SPACs have been front and center, but we have cases in which we've had the company get an offer from a SPAC, and then we've gone out and looked at a traditional private round. And in one case, we've ended up with terms that were twice that of the SPAC terms, and a fundraise that ended up being twice that of what was envisioned in the SPAC. So I don't think SPACs are setting the standard for the best way to raise capital by any means. I think the private markets are alive and well. At the end of the day, the investors are more or less the same. You look at the cap tables of companies that have only raised private rounds, and you look at the investors in the SPACs, and you look at investors in public companies, and you'll see many of the same names across that. And these investors say, listen, at the end of the day, we want to be in this sector or a particular company, and we don't really care that much what stage it is. Yes, there are some technicalities about how some funds can only invest in publicly listed companies, which is what got the whole SPAC thing going. But many of those investors are smart and sophisticated, and they realize that they should fix that technicality internally and do the right thing and go after the lowest cost of financing these companies as opposed to stick to one vehicle. So net, maybe a long answer to your question, but if that capital raise can change the trajectory of your company, and the only bottleneck to that accelerated trajectory to scale and timing is capital, then I encourage our companies to raise that capital, because that capital is available, and like anything else, it's a very useful tool.
Okay, so probably the last question I get to ask you. I want to talk about areas you are excited about today, because yes, we have a bunch of companies scaling. It's super exciting when you get to the point where you get to SPAC. And I mean, for you, I'm sure the Tesla news of the last 2 days was absolutely stunning, right? And they're headed to be $1 trillion company, and that's amazing. But there are all these incredible startups that are happening and just getting off the ground today. How can you help guide their thinking about how to build a really big, important company? What's the right mindset? What are the tools that, all that you've learned in your incredible investment history? What can you bring to bear today for these early stage entrepreneurs?
So I'll start with the second part first. What do I tell entrepreneurs? Actually, I'm sure you've heard some of them talk about it. One of the first questions, or one of the main questions I ask when I find an entrepreneur that's really good and passionate and interested in the space is, is this the biggest idea, the biggest problem that you think you can solve, or you have and want to build? And initially, it can almost upset them a bit, because they feel like, what, you don't like the idea that I'm pitching you? You want something else? And that's not the point. The point is that, I think I alluded to this earlier, the success of the companies, this is so cliche, but so true, right? Is really dependent on the quality of the entrepreneur and the quality of the leaders and the talent. There is, just like I mentioned, capital being a commodity, not quite a commodity, but in the places that you and I live in, Silicon Valley and Boston, or other areas like that, your favorite area, Seattle, Austin, whatever hotbed of education and innovation and technology you live in, there is no shortage of, again, technical ideas or technical breakthroughs or PhD theses that can be turned into businesses. There are a lot of those, a lot more than actually turn into real companies. The difference is marrying that with all the other things we've just talked about over the last half an hour. And so one of the big bottlenecks is the quality of entrepreneurs who are ready, willing, able, and in a position and a mind frame to be able to do it. Entrepreneurs that have the ability to take that risk, that have the luxury to take that risk. Sometimes, they have financial obligations that prevent them from really acting, or family obligations. So it's not like good or bad, it's just the reality. And so that is one of the first questions is, are you solving the biggest problem? Is this the biggest version of the company you want to build? Because it takes very similar efforts to create a company that can be going after a small thing or a big thing. Yes, if you're building a bunch of factories as opposed to something that doesn't require manufacturing, yes, you don't have to have all the manufacturing experience and talent and all, but I'm not talking about that, right? I'm talking about from an entrepreneur leader's mind share point of view. He or she is going to delegate and find the talent to do each of the pieces, but what are they personally capable of, and what is it that they're able to mobilize in their day? And the difference between doing that for a bigger end in mind versus something that feels important but is really small, it sometimes can be deceivingly similar. So that's really an important thing that I ask them to step back. And I'd urge all the entrepreneurs that you have in the audience today to really think about that. And on your first part of the question, what are we seeing? What do we think is exciting? Every time we think we've seen it all, we are thrilled with some great ideas. That is our life. That is what we live for. That's what happens here every day. We literally turn the lights off every day, and are not able to get to all the amazing ideas and entrepreneurs that are going after this space. But I talked about, electrification of everything was our first theme a decade and a half ago. It remains one of the dominant themes for us. Yes, you've got a lot going on in cars now, so there's probably less to see that's differentiated there. But now there's eVTOL, electric airplanes for various applications. The whole area of trucking remains unsolved for the most part. Aviation, beyond eVTOL, we haven't even scratched the surface because long distance aviation seems completely daunting right now for traditional electrification. So, what's the way to get that done? The ecosystem around electrification of everything is almost more important than it by itself. So, no surprise, batteries for the last decade and a half, we've been obsessed with them. We've made some investments. That continues to be a really important area. It's just such a panacea for so many things. Almost like, in computing, you could predict 20, 30 years ago, after the original sort of microprocessors came about, several decades ago, the importance of all the peripheral components that go around that, and storage in computing has been so important, and storage and energy, obviously at a different scale, is very important. Power electronics, at the end of the day, whenever you electrify something, you're going to have that interchange of power and the handling of power, and that is best done in power electronics. And so much has happened in the traditional world of semiconductors for power electronics, in the consumer world of power electronics, that crossing over to the world of both low voltage and high voltage power electronics for the energy systems is going to be amazing. Even something as esoteric as nuclear fusion, right? At the end of the day, will benefit so much more from power electronics in the future than probably most other aspects of that. And speaking of which, I think fusion is something that you mentioned in your opening comments, clearly seems to be coming of age. And another one of those examples of where it's not a new topic. It was talked about 30 years ago and turned out to be almost, I don't know what the right word is, hoaxes at that time. But that didn't mean there was anything wrong with the fundamental science. And a few decades later, it seems like it's getting ready for prime time. If I stay on the theme of things that were hyped decades ago and maybe getting ready for prime time, another area is superconducting and superconductors. So superconducting materials, applications of that approach, the intersection of different technologies which can benefit from that. I think you'll start seeing some of that. On the battery side, I forgot to mention recycling. I think, again, an old idea, but now the ability to do it at a whole different level with new technologies, and not just because recycling is a good thing and not just to recapture material, but also to reduce cycle time, also to reduce time to market and reduce cost and improve energy security. I don't know if we're running out of time. You came back on stage, but as you can tell, the list is long.
I love it.
I can tell you about another dozen things. Yes.
No, you are amazing. I really love working with you, and we could talk for hours about this, but I think your enthusiasm, your sage advice for the entrepreneurs is invaluable, and I really, really want to thank you for your time and all that you've done and are continuing to do. So thank you.
Thank
so
you,
much.
Katie, and you're so kind. And likewise, we've loved working with you and partnering with you. And thank you for what you do for the community at large through events like this and all your other efforts. And it's been great to see you get the other coast charged up. And I look forward to coming to Boston and seeing everything that you're up to.
Wonderful. Take care. Have a great day.
Thank you.
Bye-bye.
Bye-bye.